Alright guys, glad to have you on board again today. We're going to daily update our scenarios because I recorded the weekly updates on Friday and lots of things have been happening in between, specifically into the crypto sector, but not to mention that the stock market is finally switching to the narrative I've talked to you about during the latest few weeks and months, the possibilities of the market heading into stagflation territory. So now it seems to be this week's narrative as we're heading into GDP numbers in Thursday, if my memory is right. Lots of people tend to say that the early data we're getting to compose GDP suggests that the pace of the recovery might be slower than expected and so on. So slower growth and higher inflation, because that's the topic we've had the latest few weeks. Okay, stronger inflation. Now we are going to add up the weaker than expected GDP, and congratulations, you've got the formula for the stagflation narrative. Oh man, just be honest once again. So as the market is heading into my direction, I should finally be able to find some validations. At least that's what I think is the likeliest outcome in here. But still, is this stagflation narrative, the way it's put it out there by the analysts, the right way to think about it? Once again, analysts are just the biggest ever bullshitter in the market, and I hate some of their job. Some very good analysts out there exist, don't get me wrong, but most of them are just releasing paper without any added value for real investors or speculators. So they're basically just printing stuff which has no intrinsic value. Okay, so stagflation, the way you have to think about it, and certainly not the way they are printing it today. The comparison to the 70 to 80 area, okay, this is not what's going to happen, because anyhow and anyway, we never copy-paste what happened in the past. We can reference things to have a broad way of thinking, but that's by far the furthest usage of what's happened in the past that we can make. What we can use in here is the fact that, yes, stagflation might be the closest thing that happened in the past to what we might experience within the next few couple of years. But despite that, we're not going to get to similar economical conditions as the ones we've had back into the 70, 80 area. It's not going to be that way. So all of the bullshit about back then buying gold would have been the best bet. Well, so what the fuck are you telling me? Buying gold now? It makes absolutely no reasonable sense, but still, okay, if that's what you're spitting out, just keep it for you the next time, okay? So don't listen to this bullshit. Don't copy trade what's been done back in the 70s, because it's definitely not going to work this time, because it's never like that, okay? It's never working that way. But what we can take advantage of is what kind of market reactions did we had back in the 70s, 80s? Where did people park the money? Yes, into gold, defensive assets, scarce assets. That might be fueling the Bitcoin upside potential and crypto's demand. Sure thing. That's definitely what I think is on the verge to come. So buy gold. Okay, go for it. I think the scarce demanded asset right now is mostly Bitcoin rather than gold. So go for whichever ones you want. I would definitely overweight Bitcoin rather than gold in a portfolio now. Having a bit of gold, okay, but gold has definitely gone up last year, so I don't think this is going to be this year's trade. Silver might be instead, but just spitting these words out there. Okay, that's a topic for another day. So the stagflation narrative, the way it's put it out there, is dumb as usual. The smart way to think about it is, did investor pile into the stock market? No. But did the stock market move bearish? No, not at all. Was the stock market pretty much in a range? Yes. So how did you navigate that range? This is why you need to zoom in, because the market itself is not in a range in a stagflation. Sure, the overall growth number are disappointing and we have a slow growth, but growth still. Okay, it's not a recession. It's still slow levels of growth with higher level of inflation. Okay? And high level of unemployment. Are we going to get these? I definitely think we will. Are we going to get similar trading conditions than the 70s and 80s? Definitely not. The overall structure likely will be the same. People will look for defensive scarce assets, but definitely not the same ones. People will look for defensive stocks, but also will look for offensive growth stocks to get the best of the tiny growth that will be there, because the growth, if you look into it, is diversified. It's spread out into multiple sectors. Some sectors do have some severe growth, even in stagflation. So these are the ones you want to target. The asset classes that will bring out gains that will outpace the inflation. And in these assets, you'll be able to make some real money. And what you want is to avoid areas of the market that will either lose a lot of money, because you will take the double digit on the double losses in here, because you will take monetary losses due to inflation, and in the same time the losses due to the losing grounds of your assets, the assets you purchased. So this is basically as it is. You're going to return to cash, with cash being devaluated, and you're going to take double losses from both the investments you've made, bad investments, and losing out of inflationary pressures on top of it. So this is what we want to avoid at best. So which kind of asset classes could be suffering the most into such conditions? Well, nowadays we do have a credit bubble that didn't existed back then into the 70s and 80s. So once again, the stock classes that will be impacted will never be the same as the one that were either demanded or suffered from losses back then. So never copy paste, okay? There is, in the background of it, a defensive layer of the market that doesn't look for gains, but just looks at outpacing or at least equaling the inflation. So some defensive stocks that can bring 4 to 5% a year to cover for inflation. These trades don't bring money. They're just there to park the cash to avoid the deflationary pressures on this cash. Okay, so parking cash on defensive sectors that can bring 4 to 5% a year, end of it. They don't look at outpacing the stock indices, just park the cash into safe assets that bring dividends and that will still make money into these stagflation periods. To name them, energy sectors, networks, and some things like that. Like, think about internet companies, cable companies. No, not necessarily cable, but the Ciscos. These assets will deliver the money without too much risk. So these are probably going to be demanded assets without bringing shitloads of gains. They will not grow as fast as people expect them to. You're not going to double the gains into Ciscos if you are piling into this now. Okay, so it's more like, between the time you get in and out, you just want to cover inflation's costs, okay? On the second hand, we look for offensive sectors that can bring out the tiny little growth there could be into the stagflation perspective, because there are definitely some sectors that will perform just like crazy normal growth periods. Some assets will thrive really to the world, that will really thrive. And some other classes, that's what creates stagflation. Some very, very, very productive stock sectors, just like some others, will go for bankruptcies. That's what we're going to get. Lots of bankruptcies due to the heavy amounts of debt we have and the deteriorating credit conditions, because no growth will deteriorate credit ratings, which will inevitably create some bankruptcies, and these will inevitably put pressures on the shittiest junk bonds and so on, and these companies will die one after another, and these will put the downside pressure on growth that will fail to compensate and that will totally outpace the big gains we can make on some more offensive sectors. So we've got the motive: sell the overloaded leverage stuff, okay, sell the indebted companies and so on, and you got the motive. Not at all. Growth will be supported by debt. So if you're selling everything that is indebted, you're probably going to sell some of the diamond hands that may show up out there. So debt is not necessarily the issue. It's not the only thing you want to look for. You want to look for stocks that have the potential to deliver growth, even if they are indebted. We never create growth without debt. So debt is not the problem. Just don't fly away from debt. Don't think of it that way. But old companies that have a long history, and they have, which are loaded with debt, will probably die within the next few years. Okay, so these are the companies you don't want to put your money into. Okay, I'm talking about the General Electrics and things like that. Long-term companies, debted a lot, which will probably not going to recover from the COVID pandemic second waves. Okay, but think of it that way. Lots of offensive sectors, like probably everything that is related to medical sector, biotechs, these things might be working just fine. Gaming companies might be gaining, all of these things might be working. Okay, of course, I don't have the magic bubble that will tell me where to park the money safely and make the nice digit gains, but still, I think these are the areas in which I'm parking my personal money. But we'll see about that later. So don't think about the stock market to either be bullish or bearish, but stocks, individual stocks, will probably be. Okay, so this is what you want. Stop looking at indices, but look at indices to get the proper timing. What I think is that now indices are building a market top. I don't know what structure it will be like. Are we just going to range before breaking down the range, or are we just going to fall off the cliff if the top 10 stocks are fucked up during this week? Because earnings release will definitely fuel the bearish potential if it ends up disappointing market participants. But that's a topic for another day. So right now, looking for the reversal pattern to exploit themselves. As of right now, we just failed last week to validate the bear moves. Well, we could just be doing it this week. This wouldn't change anything. To my personal perspective, all of the red flags are already in place, and I don't nearly think the bulls have it under control. I think despite that, we finally succeeded making lower lows on the momentum, totally suggesting to me that the next time, the support will be fucked up immediately. So the intermediate support we've tried to build last week feels a lot like the retail traders buying the latest dip in the bull trend before we've succeededly fuck it all up. Okay, so I don't think there is a support that has been built out there, because I just believe this is dumb money dip buying, which will very likely do not constitute a support if we return out there. So definitely an interesting week to look for when it comes to the stock market. But like I said, don't look at it through the S&P 500's eyes. Look at the 10-year yields and the dollar index. I believe the 10-year yields is very likely going to oscillate across these levels to both orientate the fact that we have downside pressures on yields due to low growth, to lower growth than expected, but still the problem is inflation is expected to remain high and certainly not transitory. So we have upside pressure due to rising inflation, but downside pressure due to the fact that there is no growth, and therefore we do not anticipate the Fed to raise to rise interest rates. They will probably remain at zero. We're probably going to get a tapering, okay, but we're probably not going to get interest rates risings. So this is what the bond market is trying to price in. And to my personal extent, I think this is very likely going to build some kind of an ugly range throughout the next few weeks, range that will very likely going to break to the upside without the surging and so on. Don't think about trend. I think we're going to extend the range on the high time frame. We've gone from context to context, and to be fairly honest, I believe that we are very likely going to neutralize this range. So I expect staying there for a little longer, the time for us to reverse this context to the downside, and we're probably going to neutralize around the 1.50 mark, which seems to be the targeted mid price for this range. So we're going to oscillate across. Sell when you were above, buy when you were below. Simple as that. Okay, DXY is showing signs of reversals. Just like I said, the inflationary pressures keep being there, and we don't intend them to be any such a thing as transitory. So normally the dollar index should start deteriorating. Once again, I expect similar pace, even faster one, because then generally the second wave is more violent. So I expect quite a tense and lots of tension around the dollar within the next few weeks. Most of it due to the big names. So I definitely think that the story is not about GDP itself. I think it's more about the GAFAMs that we're going to have earnings throughout the week. So definitely pay attention to this. When it comes to our beautiful crypto markets, well, it has been hell of a thriving Monday. We have to talk about that, but of course the same old contextualization is required. And to be honest, in here I see a lot of people opening their mouth for absolutely staggeringly stupid reasons once again, because technically speaking it makes no sense. We go immediately from oversold to overbought, which means whatever we've done in here makes no rational sense, but to say that we finally succeeded testing the first available bearish resistances level. Is this an actual technical resistance level? No, it just means that in order to find resistance, we need to be above this line. So we finally try to dip a toe in here. Is there any significant level of resistance out there? The answer is no. Pure and simply, it isn't. So there's nothing to care about out of these areas. The only thing we have to care about is what's going to happen next. Are we going to keep inching higher with the current violent pace in which we're just fucking up the bear stop losses? Or are we really into the restatement of a bullish market? I don't have the answer. That's the answer I'm seeking, actually. We've gone from oversold to overbought. That's the thing I can tell, because that's what I expected after a squeezing pattern, to just shake out bulls and bears into a stupid, unpredictable manner. But now that we've flushed the bulls and the bears, and now that we have retraced right back to average values, what's next? Well, to be honest, I don't know. I just think that, as usual, we come out of a monthly or weekly to monthly supportive area. So I would tend to say that we're very likely going to set prices over the average value. But that's also the things I've forecasted for the entire July month, with a question mark on top of it, obviously, because nothing's ever for granted. But we're pretty much nearing the end of July. So are we going to settle prices right there, right before the end of July? I would say that's a possibility. I would need to get today's candle close confirmed first. But if we were to close above today, meaning that would be a Murabuzu candle, that would mean that we're probably rejecting the bear side territory. I think that the next move will likely be to try testing how high we can settle prices. So after trying to see how low, we're very likely going to try how high. And in that perspective, I would say these resistances seems a lot more appropriate. And this is the $1.7 trillion mark that we've talked about into the weekly updates. So I still stand for what I said. I believe this is where we're heading. I just don't know how long it's going to take. We're going to have a monthly candle close, which do not give us that many informations. So I would say probably August to September will be definitely the most interesting month to trade. So are we going to reach out the 1.7 trillion mark before? I would say reasonable probabilities to do such a thing, depending mostly on what's going to be today candle. If today's candle is a Murabuzu candle crossing above the median values, very likely we're going to look for the first available resistance levels, and they are higher than the current prices. But just like I told you not to pay too much attention to the S&P 500, I tell you not to pay too much attention to the crypto total, because in here, if we just bear looking at the structure underlying the prices, we'll see that this is mostly absolutely scattered performance. Most of it is due to the Bitcoin dominance recent move. In a couple of days, Bitcoin has seriously restated its market cap, where altcoins have followed, sure thing, but certainly not into the same extent. So the Bitcoin dominance is right back up, trying to test the resistance in here. We're still trading with the cluster around the 23% Fibonacci level, and if this cluster were to fail, then in that perspective, we would eventually inch right up to the 38% cluster, which will be, let's say, something in between 52 to 54 in terms of dominance. So in my personal opinion, we have a deteriorating value, average value, median value, right below a deteriorating average value, still leading me to believe that the pressures are by far to the downside. We've closed below the higher time frames context, suggesting that this is at least a bare minimum for the next quarter. So I would say that the pressures are far more bearish than bullish. So are we just fighting 2 bullish days before reversing? In here, I would tend to say this is pretty damn likely. I'm really just questioning the reality of this. I want to see proof that the market rejects for the final time, probably because that would be 3 times in a row. The range, though, will be mature to reach out to the support with very likely probabilities to finally break this trend line and eventually retrace right down to the bottom area of this range to see if we can accumulate eventually and break to lower values. If we have such a thing, then that means altcoins will finally get to perform again and shine once again. That's the reason why I would tend to say that I'm definitely looking at Ethereum first. For a simple reason, because that's the motive we've seen recently. Bitcoin sets the motion, then the motion ripples through Ethereum to Ethereum, and then Ethereum opens the door for the lower cap altcoins to perform one after another. And we are going from quality trades to lower quality until, of course, there's not enough money to support the upside move, and we all take profits. Like I said, targeting the 1.7 trillion mark into the global crypto sector seems to be the appropriate timing to start looking for profit taking. So as of right now, I would say we just tasted the first resistance. That doesn't really look like being one to me, though I really look at altcoins to see if they're going to follow up just like they did the last time, or if they won't. Because I think Bitcoin's move is now late, and this is not an appropriate time to get into Bitcoin. So I'm looking at speculators' performance to see if they pile up into altcoins or if they are feared out because of what could happen in the stock market. Like I said, I would like to see finally the opposite pattern I've talked about into the weekly update, in which I would like to see both of these riskier assets perceptions from investors being inverse correlated. I want to see them selling the shit out of their indices, still buying into cryptos, which will fuel not a thriving let me just grab an Ethereum, not a thriving Ethereum, but a Ethereum that anytime it tries to go down, find its way back up until it reaches out average valuations, which seems to be closer to 3,000 rather than the current prices we're dealing with. So I think there is still upside potential, but if you think it's going to be dealt with in just a couple of days, I would tend to disagree. I think that we're going to have an oscillating market grinding to the upside much more than anything else. But that's what I'm looking at, okay? If we get that, and if Ethereum succeeds maintaining upside pressure and so on, I think by just a few days, normally we should see lower cap coins following accordingly. We need to have the door open by Ethereum first, and others will likely follow. This is what I think could drive the crypto total to the 1.7 trillion mark. We're having a Bitcoin that just basically stays stays where it is. Okay, so I think Bitcoin has a slight upside potential, but I think it's very slight of one. And like we stated, this is where we want to see the sign of strength. Market reaching out to the previous resistance and ranging short term. The range, and the kind of range in which I want to definitely study the altcoin's performance to see if the market is on the verge for greed trades. Do we want to reactivate the trend, or are we on the verge for a longer range, or do we have market participants totally scared out of the bearish probabilities in Wall Street? Okay, so that's the week ahead topic. Most of what's going to happen into crypto is going to depend on the big names, technology sectors, top 10 stocks. And we would like to see them decorrelated moving. So if they ever lose some money, I want to see altcoins still managing to hold on to their supports and gaining on the retracements. Okay? That being said, see you guys later this week, because we're going to make another daily update for the monthly candle close. So see you guys later.